London has always been seen as the beating heart of global finance, a place where markets move, banks trade, and billions of pounds shift every second. But if the city is the heart, then LIBOR was its pulse. LIBOR, the London Interbank Offered Rate, was once considered the most important interest rate in the world. It was supposed to reflect the cost of borrowing between major banks in London, and its movements quietly influenced nearly every type of loan imaginable. Mortgages, credit cards, student loans, government bonds, corporate debt, swaps, and financial contracts worth hundreds of trillions of pounds worldwide. For decades, people believed this number came from honest market activity. They believed it represented the true cost of money. What they did not know was that this benchmark was being quietly twisted, massaged, and manipulated behind the scenes by traders and bankers who saw LIBOR not as a responsibility to the world, but as a tool to boost profits, reduce losses, and win bonuses. To understand how the scandal happened, we need to understand how LIBOR worked. Every morning, a group of major banks in London were asked a simple question: at what rate could you borrow money from other banks today? They would submit their answers, and those answers were averaged to create LIBOR. That number was then published and used across the entire world. The flaw in this system was obvious, but it took years for anyone to notice it. The number was based not on real transactions, but on estimates. It relied on honesty. It relied on integrity. It relied on banks submitting truthful data. In an ideal world, that would work. But in the real world of high-stakes finance, traders quickly realized they could move the number up or down to help their trading positions. If a trader needed LIBOR to be slightly lower to win a multi-million-pound bet, they could simply ask the person submitting the rate to adjust it. And because LIBOR could move global markets with tiny changes, even the smallest manipulation could make or save millions. The first cracks appeared during the 2008 financial crisis. As global banks struggled, LIBOR suddenly stopped making sense. Some banks were reporting extremely low borrowing rates, even when the markets showed panic and fear. Why? Because banks didn't want to look desperate. If a bank admitted it was borrowing at high rates, that would signal weakness and might trigger a run. So they understated their borrowing costs to appear healthier than they were. This was the first form of manipulation: reputation protection. Then investigators discovered the second form: pure profit manipulation. Traders were found sending messages like, "Can you bump LIBOR up a bit today?" Or, "Keep it low, mate, I need this to hit my target." These weren't one-off mistakes. They were part of a routine. LIBOR was being shaped by private conversations, not real markets. It wasn't a benchmark. It was a number built on nudges, favors, and pressure. When regulators began investigating, they found messages between traders that sounded less like professionals handling global finance and more like friends swapping favors at a pub. Traders casually offered each other meals, drinks, and even promises of bottles of champagne in exchange for shifting the rate. The tone of the chats revealed something alarming. The people involved didn't see this as a crime. They saw it as business as usual. For them, LIBOR was not a sacred benchmark that controlled the world's borrowing costs. It was a game. Every handful of basis points, tiny decimal movements, was a win. And those wins meant bonuses, promotions, and personal profit. In one infamous message, a trader simply said, "If you keep it like that, you're a legend." That one line summed up the culture of the time: casual, arrogant, reckless, and shockingly unaware of the consequences. The consequences, however, were enormous. LIBOR influenced an estimated $200 trillion worth of contracts globally. British mortgages tied to LIBOR changed in cost. University students paid interest on loans affected by LIBOR. Pension funds saw their values shift. Companies negotiating huge contracts ended up paying millions more or less because of these manipulated movements. Even governments issuing bonds were affected. When LIBOR moved artificially, it caused real financial pain for ordinary people who had no idea their monthly payments were the result of secret messages between traders. It was not just a London scandal. It was a global shockwave, and the epicenter was the City of London. As the investigation expanded, some of the world's biggest banks were brought into the spotlight: Barclays, UBS, RBS, Deutsche Bank, and others. Barclays became the first major bank to admit wrongdoing, and its CEO resigned shortly after the revelations became public. Regulators uncovered years of manipulation involving multiple banks, dozens of traders, and millions of messages. The fines were enormous, reaching billions of pounds across institutions. But the deeper question began to overshadow everything. How could a handful of traders influence the world's most important interest rate? How could a system so important rely on nothing more than trust? The LIBOR scandal exposed a fundamental flaw in modern finance, a flaw created by an outdated system that had anti-evolved to match the scale of global markets. The fallout forced governments and regulators to redesign the entire benchmark system. LIBOR began to be replaced with rates based on actual market transactions, not estimates. The Bank of England and the Financial Conduct Authority introduced new rules meant to stop this kind of manipulation from ever happening again. Training, oversight, compliance, and transparency became mandatory. But for many people, the damage was already done. The scandal shattered public trust in banks, especially in Britain, where some of the most respected names in finance were found guilty of shaping global markets for personal gain. LIBOR had shown the world that even the most sophisticated financial systems could be vulnerable to something as simple as human greed. Yet the scandal also revealed something deeper about the structure of the financial world. It showed how concentrated power was in a handful of institutions in London. It showed the world how dependent global markets were on decisions made by people inside a few skyscrapers. It showed how a single benchmark could become a global vulnerability. And it raised a question still relevant today. Should a small group of banks in one city have so much influence over global finance? LIBOR may be disappearing, but the system it exposed, a system built on concentrated financial power, still exists. London remains a global financial hub, and benchmarks continue to shape markets. The LIBOR scandal was not just about corruption. It was about the fragility of a system built on trust without verification. For Britain, the LIBOR scandal became a defining moment. A reminder that even powerful nations can make mistakes that shake the world. It forced the country to rethink how financial benchmarks operate, how banks are supervised, and how global trust is maintained. The scandal became a turning point in regulatory history, leading to new laws, new oversight mechanisms, and tougher penalties for misconduct. It also reshaped the City of London's reputation, not destroying it, but forcing it to evolve. Britain learned that reputation is built slowly, but can be shattered instantly. And the city learned that transparency was no longer optional. As we conclude this story, remember this: LIBOR was just a number, but behind that number was the power to shape lives, markets, and nations. When a few traders manipulated it for profit, they didn't just break rules, they altered the global flow of money. They changed mortgage bills, interest rates, investment returns, and government borrowing costs. They rewrote the financial lives of millions without their knowledge. The LIBOR scandal is a reminder that the world of finance, though vast and complex, is still shaped by human decisions. And when those decisions are careless or corrupt, the consequences reach far beyond trading floors. If you found this deep dive into the LIBOR scandal informative, make sure to like the video, share it, and subscribe to British Economic Archives for more hidden stories from Britain's financial past. Your support helps us uncover the truths behind the systems we all live under. Turn on notifications so you don't miss our next investigation, where we reveal how Britain's most powerful financial institutions shaped the world you live in today. Thanks for watching, and remember, always question the numbers that shape your life.